India in 2026 is probably going to be even more on the rise. I saw some news that made me wonder, just how attractive is India as a destination for global capital? Why is it that JPMorgan is putting in so much effort, to the point where they've managed to reclaim the top spot as the #1 bank in equity capital markets, or ECM, for the first time since 2020? Seeing that made me curious. Wow, does India really have that much potential to attract investment? Just how attractive is India to global capital that the world's biggest banks are now choosing India as the top Asian country, not China anymore? And I also wondered, does that mean India is going to overtake China? Will India follow the same pattern that made China so wealthy? But let me spoil it for you. India isn't doing things the way China did. They're taking a more modern approach. In this video, I'll break down the numbers for you, from economic stats and demographics to India's strengths. And I'll also talk about the risks facing India. If you want to support this video about India and find out whether it really is becoming the world's new investment magnet, you can do so by scanning this QR code. Or if you want to support the Money Monster channel, it's super easy. Just hit like, share, or drop a comment to chat with us. But what I'd love most is if you'd subscribe to the channel. Please hit that subscribe button. All right, let's raise our kids together in this video. Let's start with this headline that really made me curious about just how much India can attract investment. The headline was that JPMorgan has reclaimed the #1 spot as the top ECM bank in India, overtaking Kotak Mahindra Capital, which is the homegrown ECM leader in India. Now, let's take a look at the competition in this league. JPMorgan is now #1, right? And the competition for the next spots is intense because all the big players are involved. JPMorgan at #1, right? Second place goes to Citigroup. Third is the homegrown player Kotak Mahindra Capital. And in fourth place, it's Goldman Sachs. You see how big these names are, right? Okay, so what do they see in JPMorgan? Can I agree with that? As soon as I act, they don't make any adjustments. But luckily, this information isn't really a secret. So I went and opened up JPMorgan's report, this one right here. It's basically JPMorgan's financial report for the second half of 2025. The first thing that really caught my eye was how colorful it is. It's not just a regular financial highlight. This one is really highlighted, and I went along with their highlights too. They compare data over 6 months, 3 years, 5 years, and 10 years. But before I share this information with you, let me just say that this is a projection. Even though it comes from JPMorgan, it doesn't mean it's going to be 100% accurate. When you look at this data, you need to use your own judgment. Okay, so here's the data from JPMorgan. Let's start with this, the very first line. Share price return, or the stock price return of JPMorgan India. For the past 6 months, it dropped by 4.8%. Over 3 years, it went up by 24.6%. Over 5 years, it increased by 121.0%. And over 10 years, it rose by 73.7%. What does this mean? It means that if you invest with JPMorgan in India for the short term, like 6 months, the price will go down. But if you invest for 5 years, that's a 121% increase. The price more than doubles. Now, the second row, net asset value, or NAV per share return, which is the return. The actual asset value per share, over 6 months, it's the same, down 7.2%. Over 3 years, it goes up by 20.2%. Over 5 years, it also doubles, up by 112.9%. And over 10 years, it's still up by 82.1%. This means that the NAV drops pretty sharply in the short term, down 7%. But in the long run, it grows a lot, much more strongly. Moving on to the third row, benchmark return, which is the overall return of the Indian market. In parentheses, that's the reference index. Over 6 months, it's also negative, down 10.6%. Over 3 years, it's up 24.7%. Over 5 years, it's way up there, up 144.2%. And for 10 years, it goes up another notch, up 144% here. Overall, the Indian market is insanely strong. What other market growth like this in 5 or 10 years? Well, maybe some, but up 145%? That's just a projection. It doesn't mean it'll actually happen. The fourth row shows the NAV return compared to the JPMorgan benchmark. It compares the Indian market against investing with JPMorgan. So this shows that over 6 months, it's up 3.4%. But if you invest for 6 months, JPMorgan actually performs 3.4% better than the Indian market. However, if you look at 3 years, it's down 4.5%, meaning JPMorgan underperforms the Indian market by 4.5%. And for 5 years, it's down 31.3%, which means JPMorgan significantly underperforms the Indian market. And if you look at 10 years, it's down 62.5%, which means JPMorgan underperforms the Indian market by 62.5%. This shows that India delivers high returns, and beating the Indian market is extremely difficult. JPMorgan even predicts that even they themselves might underperform India's long-term benchmark. To put it simply, JPMorgan might not be able to outperform. But India, on the other hand, is just soaring. So the next question is, why did JPMorgan choose India as the top Asian country? The first reason is the basic numbers. India's GDP still grows at an average of 6 to 7% per year, which is a huge number for such a large country. For example, China can't achieve these numbers anymore. Going forward, China's growth will probably be in the high 4% range. The second reason is that India is a major economy. It's actually the 5th largest in the world. The third reason is that India's working age population is still growing. This is a key factor driving India's economic fundamentals upward. If you compare this to China, China's working age population is actually declining now. It peaked in 2015 when China had the highest number of working age people, but since then, it's dropped by about 40 million. That's the opposite of what's happening in India, because India's working age population is still increasing. And the fourth point is that India's stock market has strong domestic capital. That's because India doesn't rely too heavily on any one country. They don't depend too much on the US, and they don't rely heavily on China either. For example, when the United States asked all its allies to sanction Russian oil, did India care? India barely paid any attention. India's Prime Minister, Mr. Modi, told the US that he said, how could they possibly stop buying Russian oil when Russian oil is cheap and it's good for India's economy? So India has to put its own people first, before America, in parentheses. And yes, India can buy Russian oil and America can't do anything about it. India can buy chips from Taiwan and neither China nor the US really says anything. Or if India wants to buy defense systems from France, it can do that too. Especially now with the ongoing trade war, right? The US has imposed a lot of trade barriers and tariffs on China, a whole lot. So this has made big companies avoid setting up manufacturing bases in China, and a significant number of them are now setting up in India instead. For example, Apple is now manufacturing iPhones in India. They manufacture more than 5 million electrical appliances in India. Toyota, Honda, and Suzuki are investing billions to build car factories in India. Honestly, India is like an oasis in the desert, because this kind of flexibility is extremely rare in today's divided world and trade war era. This gives India a huge advantage. The fifth point is about India's IPO boom, because there has been a lot of India's IPO boom has been going on for years, and it just keeps growing. The IPO boom in India really took off after COVID, specifically in 2021. That year, there were 63 IPOs, raising a total of $16.9 billion. By 2024, the number of IPOs increased to 268, raising a total of $19.5 billion. And in 2025, there are also IPOs. There are about 102 more IPOs coming out, raising over $20 billion. And another important thing to note about the Indian market is that investment, whether it's through IPOs or in the Indian market in general, is very diversified across industries. The investors range from institutions, retail investors, SMEs, and the whole ecosystem. This means that investing in India is spread out across different industries. This means that the risk is spread out. It's not concentrated in any one sector. It's not just about AI or just tech or anything like that. They invest in everything. Now, I can't help but wonder, will India actually surpass China? And if so, is it because India's population has already overtaken China's? Or is it because India's working age population is booming and growing rapidly? Could that be the reason they'll surpass China? Because if that's the only reason, then this is exactly the same pattern that China once followed and became wealthy since the 1990s. But does that seem outdated now? Does it really fit the current situation? Especially in an era where there's a huge labor force in cheap labor. Can that really compete in the global economy? Because now everyone's using automation, right? Let me quickly recap the formula that made China wealthy. Back in the 2000s up to around 2010, China's GDP grew at double digits, an average of 10% per year. That growth lifted more than 800 million people out of extreme poverty and into the middle class. This was thanks to free trade and cheap labor, which turned China into the factory of the world. Eventually, China became the world's second largest economy, mainly because cheap labor gave it a competitive edge. But the reason why China's old success formula doesn't work anymore is because today's world has AI, automation, and robots. And now, using automation systems is actually cheaper than using cheap labor. That's why the old formula China used just doesn't work in today's world. So what is India doing differently from China? First of all, India never tried and never intended to become the world's cheapest factory. Instead, India has focused on developing a highly skilled workforce to meet global demand. India's strength lies in education. The country is able to produce a large number of highly skilled workers, including experts in accounting services, software design, and on top of that, Indians are also highly proficient in English. They're able to comply with various regulations, which is a huge difference from Chinese labor in the 1990s. The second point is that India isn't trying to become the world's #1 exporter. Instead, India is working to make trade, exports, and doing business with India easier. India has developed one of the most advanced digital infrastructures in the world. Quietly, through a system called Aadhaar, which is a universal ID, or UPI, an instant payment network. There's also India Stack, which is a platform for sharing information in India. This allows citizens, SMEs, or really anyone to easily access data within India's system, making transactions much simpler. To put it simply, everyone can access government systems, banking systems, or any other systems that used to be complicated. Now they're not complicated anymore. But if you ask whether this system is perfect or fully completed yet, the answer is no. It's not perfect or fully finished yet, but at least they've started. Now, does India have any risks or weaknesses? Of course it does. There's nothing without risks. For example, electricity in India still goes on and off from time to time. The roads in India are still congested, and honking is super common there. It's really popular. Are the ports in India slow? Yes, they're slow. Businesses still complain about unpredictable changes in local regulations? Yes, they're still complaining. One of the main obstacles in India's system is the issue of equality, especially caste inequality. Because in reality, most people in India aren't from the high castes. They're farmers and laborers and so on. A large number of people don't get the same educational or job opportunities as those from higher castes. This means that India's potential to utilize its human resources might not be fully realized or maximized, not enough to match the actual resources they have because of the caste system and class divisions. Anyway, this clip is getting long and I have to go take care of my kid now. If major international global banks are so focused on India, competing fiercely to get their share of the market there, then Try Money Monster will also be one of those closely watching India in 2026. If you're interested in following stories about India, make sure to subscribe to the Try Money Monster channel. We'll keep you updated because India is right at the center of a massive economic and financial transformation, the biggest one in the world right now. Myanmar, it's time to say goodbye. Bye-bye to Myanmar.